January 30th, 2026. Silver crashes from $120 to under $90 in 24 hours. At the exact same moment, America's largest precious metals dealer goes dark. The London Bullion Market Association, the very institution that sets global gold and silver prices, reports system failures, and while the world watches prices collapse on their screens, something else is happening in the vaults. Something the price chart isn't showing. Delivery notices are flooding in at record levels. Physical metal is moving. But the question nobody is asking is, where's it going? And why can't retail investors buy it when the price is supposedly crashing? Welcome to Global Finance Revealed. If this is the first time someone has shared one of these analyses with you, there's a small button below this video, the subscribe button. Think of it like keeping a reliable financial newspaper on your desk. Except this one doesn't cost anything, and it might just help you understand what's really happening with your wealth. No dramatic music, no predictions, just patterns. Data and questions the mainstream financial press isn't asking. We'd also like to know, from which corner of the world are you watching this? Are you watching from the United States, from Europe, from Asia, or somewhere else entirely? Drop your location in the comments below. It helps us understand who's paying attention to these market signals and why. Now, let's examine what actually happened on January 30th, 2026. On the morning of January 30th, 2026, a businessman in Dallas attempted to purchase silver coins from JM Bullion's website. The page wouldn't load. He refreshed. Nothing. He checked his internet connection. It was fine. Every other website worked perfectly. But JM Bullion, one of America's largest online precious metals dealers, was inaccessible. He wasn't alone. Across the United States, thousands of customers reported identical experiences. The website was down, the phone lines were overwhelmed, and the timing was remarkable, because at that exact moment, silver prices were collapsing. The metal that had been trading above $120 per ounce just hours earlier was now plunging toward $90, a 25% drop in a single day. The kind of price movement that, in normal market conditions, creates buying opportunities. The kind of crash that should have made physical silver more accessible, not less. But accessibility was precisely what disappeared. While JM Bullion systems were reportedly experiencing technical difficulties, something else was happening across the Atlantic. The London Bullion Market Association, the LBMA, the organization responsible for the global gold and silver pricing mechanism, reported that its clearing and settlement systems were offline. Not sluggish, not delayed. Offline. For those unfamiliar with precious metals market infrastructure, the LBMA is not a minor player. It is the backbone of global bullion trading. When the LBMA's systems go down, it is equivalent to the New York Stock Exchange ceasing operations during a market crash. It simply doesn't happen without consequences. Yet on January 30th, it happened. 3 simultaneous events. A price collapse in silver futures, a major retail dealer going dark, and the world's primary gold and silver clearinghouse experiencing system failures. To the casual observer, this might appear unfortunate but coincidental. Technical problems happen, markets crash, systems fail. But to anyone who has studied financial market history, to anyone who remembers 2008, to anyone who understands how physical commodity markets actually function, this pattern is not new. It is familiar. In March 2008, during the early stages of the financial crisis, precious metals dealers across the United States experienced similar disruptions. Websites crashed, phone systems were overwhelmed. Delivery times extended from weeks to months, and yet, during that same period, futures prices for gold and silver were falling. The official explanation was simple. Unprecedented demand was overwhelming dealer infrastructure. But if demand was overwhelming, if customers were desperately trying to buy, then why were futures prices falling? That question was never satisfactorily answered in 2008. And 18 years later, on January 30th, 2026, the same question resurfaced. The precious metals futures market operates on a specific principle: price discovery through the interaction of buyers and sellers. When selling pressure dominates, prices fall. When buying pressure dominates, prices rise. This is fundamental market mechanics. But physical precious metals markets operate differently. In the physical market, there is no infinite supply. There are only the bars and coins that actually exist. In vaults, in refineries, in transit. When demand for physical metal exceeds available supply, something has to give. Either prices rise to ration the limited supply, or access to the physical market becomes restricted. On January 30th, access became restricted. JM Bullion's outage prevented retail customers from purchasing. The LBMA's system failure disrupted institutional settlement. And yet, in the futures market, prices continued to fall as if supply were abundant and demand were collapsing. This is the contradiction that demands examination. Because while retail investors were locked out, while websites were down and clearinghouses were offline, Another part of the precious metals market was functioning perfectly: the delivery system. In the futures market, January 30th was first notice day for the February gold contract. This is the day when contract holders must decide, roll their position to a future month, or stand for delivery and demand physical metal. And the delivery notices, the actual demands for physical gold, were flooding in at extraordinary levels. So the question becomes unavoidable. If demand for physical metal is surging, if delivery notices are at record highs, if customers are desperately trying to access the physical market, then why is the price collapsing? And why is access being restricted at precisely the moment when a price crash should make metal more available, not less? The answer to that question requires understanding what delivery notices actually reveal about the physical market. At 9:47 a.m. Eastern Time on January 30th, 2026, a data analyst in Chicago noticed something unusual. He was monitoring web traffic patterns for major financial services platforms, a routine part of his work analyzing digital infrastructure loads during market volatility. JM Bullion's website had gone completely dark, but the traffic data told a different story than the official explanation. According to standard distributed denial of service monitoring systems, there was no unusual spike in traffic to JM Bullion servers immediately before the outage. The load patterns were consistent with normal high-volume trading days. Not extraordinary, not unprecedented, just elevated. The analyst had seen truly overwhelming traffic before. He had monitored systems during actual crash events when panicked users flooded websites. This wasn't that. The server logs showed capacity well within operational parameters, right up until the moment the platform went offline. It wasn't a collapse from overload. It was a shutdown. This distinction matters because it changes the fundamental question. The question shifts from why couldn't the system handle demand to why was access deliberately restricted. JM Bullion is not a small operation. The company processes millions of dollars in precious metals transactions daily. Its infrastructure is designed specifically for high volume periods. Its servers are configured to handle traffic surges during market volatility. This is what the platform was built for. Yet on the day silver experienced its largest single-day percentage drop in years, the day when distressed sellers should theoretically be flooding the market with metal, the day when bargain hunters should be able to purchase at fire sale prices, the buy button disappeared. Across the Atlantic, the situation at the LBMA presented an even more complex puzzle. The London Bullion Market Association operates the global clearing system for physical gold and silver trades between major banks and institutions. When a bullion bank in New York sells gold to a refiner in Switzerland, that transaction clears through LBMA systems. When a central bank transfers gold from one vault to another, the paperwork flows through LBMA protocols. This is not a retail platform subject to unpredictable public traffic. This is institutional infrastructure serving a limited number of professional counterparties. The participants are known. The transaction volumes are predictable. The system capacity is engineered with massive redundancy. LBMA systems don't just go offline during normal market conditions. A financial operations manager in London, who spoke on condition of anonymity, described the situation this way. In 23 years of clearing precious metals transactions, I've seen system slowdowns, I've seen delayed settlements. I've never seen a complete platform failure during active trading hours. Never. The timing of the LBMA disruption aligned almost perfectly with the Asian market opening. Tokyo and Hong Kong precious metals desks came online to discover that London clearing was unavailable. Transactions that should have settled immediately were frozen in processing limbo, and during this exact window, futures prices in New York accelerated their downward movement. For those unfamiliar with how global precious metals markets operate, this created a specific technical problem. When London clearing is offline, the standard arbitrage mechanisms that keep futures prices aligned with physical spot prices become disrupted. Traders who would normally buy physical metal in London and simultaneously sell futures in New York to lock in risk-free profits couldn't execute the London side of the trade. This arbitrage activity is what prevents futures prices from diverging too far from physical reality. It's the mechanism that keeps paper and physical markets connected. When that mechanism breaks, prices can move in ways that don't reflect physical supply and demand. They can reflect something else entirely. By 11:30 a.m. Eastern Time, a pattern had become visible to anyone monitoring multiple data streams simultaneously. Every time silver futures showed signs of stabilizing, every time the price decline began to slow, a fresh wave of selling would emerge in the futures market, driving prices lower again. But these weren't small retail traders panic selling. The order sizes were institutional, the execution patterns were algorithmic, and the directionality was unmistakable. Relentless downward pressure, timed perfectly to prevent any price recovery. Meanwhile, JM Bullion remained offline. LBMA clearing remained disrupted, and retail investors remained locked out of the physical market. The question facing serious analysts became unavoidable. Was this market dysfunction, or was this market management? Because if infrastructure failures were random technical problems, they should be randomly distributed across time. They shouldn't cluster around specific market events. They shouldn't align perfectly with futures contract rollover periods. And they definitely shouldn't coincide with record delivery demands in the physical market. Which brings the analysis to the most critical element, the delivery mechanism itself, and what the data from the futures exchange was quietly revealing. In a windowless office in Lower Manhattan, a compliance officer at a major futures clearinghouse was reviewing delivery notices for the February 2026 gold contract. This was routine monthly work. Except nothing about the numbers on his screen was routine. He double-checked the figures, then he pulled up historical comparison data going back 15 years. The delivery notice count wasn't just high, it was anomalous. For context, most futures contracts never result in physical delivery. Traders buy and sell contracts for price exposure, not to actually receive metal. A wheat farmer might sell futures to lock in harvest prices, but a hedge fund trading wheat futures has no interest in receiving truckloads of grain. They close their positions before delivery becomes obligatory. Precious metals futures operate the same way, usually. Typically, fewer than 3% of gold contracts reach the delivery stage. The rest are closed, rolled forward, or cash settled. The futures market exists primarily for price speculation and hedging, not physical allocation. But February 2026 was different. The compliance officer was looking at delivery notices representing over 20,000 contracts. Each contract equals 100 troy ounces of gold. The mathematics were straightforward. Someone was demanding physical delivery of more than 2 million ounces of gold. That's approximately 62 metric tons. To understand the significance, one must understand what these delivery notices actually represent. They are not requests, they are legal obligations. When a contract holder stands for delivery, the clearinghouse must provide the physical metal. There is no negotiation. There's no cash settlement unless both parties agree. The metal must be delivered. And someone, or more likely, multiple institutional someones, had just demanded 62 tons of gold from a system built primarily to trade paper contracts. The compliance officer began tracing the counterparty data. Who was issuing these delivery notices? The pattern that emerged was striking. A significant portion came from Asian financial institutions, Chinese banks, Hong Kong clearing firms, entities with access to large capital pools, and a documented preference for physical assets over paper claims. This aligned with a broader trend that had been building for years. Since 2022, central banks globally had been net buyers of gold at levels not seen since the 1960s. The People's Bank of China had been particularly aggressive, adding to reserves month after month with metronomic consistency. But central banks don't typically use futures markets for acquisition. They buy directly from refineries, from other central banks, or from the London over-the-counter market. Futures markets are for traders, not sovereign wealth managers, unless the over-the-counter market can't provide the volume being requested, unless direct refinery purchases face production bottlenecks, unless the traditional channels for acquiring large physical positions have become constrained. Then the futures market becomes the last venue where physical delivery is legally guaranteed. The compliance officer noted another detail in the data. The delivery notices weren't evenly distributed across the major bullion banks that act as futures intermediaries. Certain banks had dramatically higher delivery obligations than others. JP Morgan Chase, HSBC, and Scotiabank appeared repeatedly in the counterparty listings. These banks serve dual roles in the precious metals market. They are futures clearing members, facilitating client trades, but they also operate physical vaulting operations, storing metal for institutions and high net worth clients. They sit at the intersection of paper and physical markets, and now they faced a mathematical problem. When a delivery notice is issued, the clearinghouse debits the short position holder and credits the long position holder. The short must provide metal. The long receives metal. But the metal must physically exist in CME-approved vaults, classified as registered inventory available for delivery. The compliance officer pulled up vault inventory data. Registered gold stocks at COMEX-approved facilities stood at approximately 8.2 million ounces. That sounded adequate. Until one considered that this inventory must cover not just February deliveries, but potential delivery demands for all active contract months. If April, June, and August, contracts also saw elevated delivery requests. If this pattern continued, rather than being a one-month anomaly, the registered inventory could deplete rapidly. And there was another factor. Not all registered inventory is immediately available. Some metal is encumbered by existing claims. Some is in transit between vaults. Some belongs to entities that have no intention of surrendering it to satisfy delivery obligations. The actual available supply might be significantly less than the official registered total. The compliance officer saved his analysis and prepared a report for senior management. His conclusion was carefully worded, but the implication was clear. The futures market was experiencing a stress test of its physical delivery capability, and if that stress test failed, if the paper market couldn't deliver metal to satisfy legal obligations, the consequences would extend far beyond a single contract month. They would call into question the entire architecture of precious metals price discovery, because if futures prices no longer reflect the cost of acquiring physical metal, then what exactly do they reflect? A portfolio manager in Singapore received an unusual phone call on the afternoon of January 31st. His contact at a London Bullion Bank, a relationship built over 12 years of regular precious metals transactions, was calling to discuss settlement timing adjustments. The conversation was polite, professional, and deeply concerning. The Bullion Bank was requesting an extension on a physical gold delivery that should have settled 2 days earlier. Not a cancellation, just a delay, perhaps 2 weeks, maybe 3. The bank assured him the metal was allocated, the vault receipts were valid. It was simply a matter of logistics, refinery scheduling, transportation coordination. The portfolio manager had heard similar explanations in 2008. Back then, major dealers cited unprecedented demand as the reason for delivery delays that stretched from days into months. Some customers who paid for metal in March didn't receive physical delivery until July. He declined the extension request and insisted on contractual settlement terms. This interaction, multiplied across dozens of institutions and hundreds of transactions, revealed something the price charts couldn't show. The physical precious metals market was experiencing settlement stress. Not collapse, not default, but stress. The kind that emerges when the volume of paper claims begins pressing against the boundaries of physical availability. For business owners and corporate treasury managers, this distinction carries practical implications that extend beyond investment philosophy. Consider a mid-sized manufacturing company that uses silver in industrial production. That company might hedge future silver needs by purchasing futures contracts, locking in prices months in advance. This is prudent risk management, assuming the futures contract can actually be converted to physical metal when needed. But if settlement delays become systematic, if the conversion from paper contract to physical delivery becomes unreliable, then the hedging strategy fails precisely when it's needed most. The company faces production delays not because silver doesn't exist, but because the mechanism for acquiring it has broken down. This is not a theoretical concern. In 2021, nickel markets experienced a similar stress event when physical delivery demands overwhelmed the London Metal Exchange's settlement capacity. Trading was suspended, contracts were retroactively canceled. Businesses that had relied on futures for hedging discovered their positions were suddenly void. The precedent exists. The question is whether precious metals markets are approaching a similar inflection point. What makes January 2026 particularly significant is the convergence of multiple structural pressures that didn't exist in previous stress events. First, central bank gold purchases have remained elevated for 4 consecutive years. Official sector demand alone absorbed over 1,000 metric tons annually, roughly 1/3 of total global mine production. This metal enters central bank vaults and rarely re-enters the market. Second, physical investment demand through vehicles like bullion-backed exchange-traded funds has remained persistently high despite price volatility. Investors have continued accumulating metal even during price corrections, behavior that suggests conviction rather than speculation. Third, mine production has plateaued. New discoveries are increasingly rare. Existing mines are depleting. The supply side isn't responding to higher prices with increased output, at least not quickly enough to satisfy demand growth. These 3 factors create a tightening physical market, and a tightening physical market makes the futures delivery mechanism increasingly critical and increasingly vulnerable. For strategic decision makers, this environment requires reassessing assumptions about precious metals exposure. The traditional approach treats gold and silver as portfolio diversifiers, assets that provide insurance against currency devaluation or systemic financial stress. This remains valid, but it's incomplete. The emerging reality is that physical accessibility itself has become a variable that must be factored into allocation decisions. It's not enough to own paper claims to metal, futures contracts, unallocated bank accounts, or exchange-traded receipts. The question becomes, can those paper claims be converted to physical possession if circumstances require it? A corporate treasurer in Germany addressed this question by shifting his company's precious metals reserves from unallocated bank storage to fully allocated, segregated vault storage with independent auditing. The carrying costs increased, but the certainty of access increased proportionally. This is the kind of adaptation that sophisticated market participants are implementing quietly, without public announcement or media attention. Because the institutions that understand monetary system fragility don't broadcast their preparations. They simply adjust their positioning and wait. What happened on January 30th, 2026, the simultaneous price collapse, dealer outages, and clearing disruptions, may eventually be explained as coincidental technical failures during a routine market correction. Or it may be remembered as the day the physical precious metals market sent an unmistakable signal that the paper pricing mechanism was losing credibility. The data supports both interpretations, which means the prudent response isn't prediction. It's preparation, not panic, not speculation, just the quiet, methodical assessment of counterparty risk, settlement reliability, and physical accessibility that defines responsible stewardship of capital in uncertain times. The price on the screen will continue fluctuating. That's what prices do. But the metal in the vault, or the absence of it, tells a different story entirely.